Hello financial fans, welcome back to another stock analysis. Today we'll be covering Netflix stock ticker NFLX. Netflix is a streaming platform that provides an extensive library of movies, TV shows, documentaries, and other forms of video content to its subscribers. The company has been a pioneer in the streaming industry, using a subscription-based model to offer ad-free content that can be watched on a variety of devices, including smart TVs, gaming consoles, smartphones, and tablets. Netflix produces original content as well as licensing content from other studios and distributors. It uses algorithms and data analytics to recommend personalized content to its user based on their viewing history, ratings, and preferences. Netflix operates in over 190 countries and has millions of subscribers worldwide. It has revolutionized the way people consume entertainment, allowing them to access a vast range of content at any time and from any location. The company is currently sitting at a market cap of $138 billion, and in 2022, they generated a revenue of $31.6 billion. 46% of their revenue comes from United States and Canada, 32% from EMEA, which stands for Europe, Middle East, and Africa, 12% from Latin America, and the remaining 10% from Asia Pacific. To determine the final valuation of the company, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health, and the growth of the company, and we'll be using a standard margin of safety of 20% that can never be below 0%. The margin of safety can either increase or decrease by the ratios that we're going to look at in just a moment, and the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in our scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we're using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. The first two metrics that we'll be looking at are the EBIT growth and the margin growth. The EBIT has grown, going from $225 million in 2013 to $5.6 billion in 2022. The average EBIT growth year over year was 50.4%, meaning a 10% deduction in the margin of safety. The margin has also gone up, going from 5.2% in 2013 to 17.8% in 2022. The average margin growth is 19.3%, meaning another 5% deduction from a margin of safety. The final two ratios that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. For Netflix, this is just over 1 year, in this case, a 133% debt to EBITDA ratio, meaning 5% deduction from margin of safety. This with a return on invested capital sitting at 11%, which barely doesn't qualify for a deduction in a margin of safety. Looking pretty good so far for Netflix. Let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. Usually, I would import the free cash flow of the company of the years prior, but in this case, the cash flow was negative for Netflix, so I've only imported the cash flow of 2022. I'm projecting expected growth rate for the next 10 years in their free cash flow of 20% annually. And with this percentage, we can determine the future free cash flow for Netflix and determine a terminal year valuation using a perpetual growth rate of 3% and a discount rate of 8.5%. This gives us a sum of free cash flow of $94.1 billion. And to get an equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $85.8 billion. All we have to do to get an intrinsic value out of this model is to divide it by the amount of shares outstanding, giving us a discounted cash flow price per share of $192.67, which is almost a 38% downside out of this model. The second model that we use is Graham's device valuation formula. In this model, we look at the earnings per share that Netflix is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds, always sitting at 4.4. And we go by the theory that a company with no growth always is sitting at a PE of 7. This gives us, with all of these metrics, a fair value of $271.63, which is a 15.62% downside of this model. The third model that we use is the multiple valuation. In this model, we look at similar companies to Netflix, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case was quite hard to find because there are no real companies that do the exact same as Netflix. But I've chosen to go with these two companies, and this gives us an average PE multiple of 35.36. All we have to do to get a fair value is to multiply by the earnings per share that Netflix is generating, which is $9.69 a share, giving us a fair value of $342.67, which is a 10.5% upside of this model. And the last model that we use is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean. In this case, we are using the PE ratio. I usually would import the PE ratio of the past 5 years, but it has deviated pretty significantly over the past 5 years, which would give us an amazing upside, which isn't realistic. So I've only done the past 3 years, and the average PE multiple of the past 3 years has been 57.72. With the current PE ratio sitting at 32, it means it's severely much cheaper than on average of the past 3 years. And this gives us a fair value of $559.24, which is still a 80.36% upside of this model. If you want access to all of the models that I use in my videos and much more, you can check in the description for my Patreon link. Anyways, getting that self-promotion out of the way, let's go look at our final overview or valuation next. Coming to our final overview, we've imported the discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $339.05 per share. Margin of safety we've determined earlier using a standard margin of safety 20%, deducting by 5% for the debt to EBITDA, 10% for the EBIT growth, and 5% for the margin growth, leaving us with no margin of safety at all. This gives us the same fair value as the average out of all of the models, and with the current price of $310.06, we get a small upside of 9.35% out of our valuation model, so it's indicating a buy. If there's any other companies that you would like to see me cover on this channel, please let me know in the comments, and thanks for watching.